Hey everyone, and welcome. Today, we're going to tackle something we all deal with, maybe without even realizing it: currency exchange rates. It sounds pretty complex, right? But really, it all boils down to one simple question.
What is a dollar or a euro or a yen actually worth? And if you think there's one simple, fixed answer, well, you're in for a surprise.
That's right. The price of money isn't static. It's always moving, always changing, thanks to this giant global machine that basically never sleeps. This one idea is behind everything, from the cost of your summer vacation to massive international business deals.
So, how does this whole thing work? We're going to break it down. First, we'll nail down what we mean by the price of money. Then we'll look at a couple of different ways to view that price. After that, we'll dive into the biggest market on the planet where these prices get set. And finally, we'll check out the different rule books that countries follow.
All right, first things first, let's get right to the core concept. When we say exchange rate, what are we really talking about? Seriously, at its heart, it's that simple. An exchange rate is just a price. It tells you how many yen you need to buy $1 or how many dollars you need to buy €1. Just think of it like a price tag on a currency.
Okay, but it's not quite that simple. There isn't just one single price. To really get what's going on, you need to know there are different kinds of exchange rates, and each one tells you a slightly different story.
So first up, you've got the nominal versus the real exchange rate. Think of the nominal rate as the sticker price you see on the screen. €1 equals $1.15. Easy. But the real exchange rate, now that's the smart one. It digs deeper and asks, okay, but what can my euro actually buy in Europe compared to what my $1.15 can buy in the US? It's all about your true purchasing power.
And here's a fantastic and kind of fun way to see this in action: The Economist's Big Mac Index. It's a perfect real-world example. A Big Mac costs different amounts all over the world, even after you do the currency conversion. That little difference is exactly what we're talking about. It perfectly shows that gap between the simple number and what your money can actually get you.
All right, now let's talk about timing. The spot rate is the price for right now for an immediate exchange. But say you're a business and you know you need to buy €1,000,000 3 months from now. Well, you can use a forward rate to lock in a price today for that future transaction. It's kind of like agreeing on a price for your Thanksgiving turkey way back in September to make sure you don't get hit with a price spike in November.
Okay, so where does all this happen? Where are all these spot and forward prices being set? Literally every second. It all goes down in the single biggest market in the world, the foreign exchange market, or just the FX market.
Now, this isn't like the New York Stock Exchange with a big building and a trading floor. Nope. The FX market is a massive, decentralized electronic network. It's just banks, companies, and investors all over the globe trading currencies 24 hours a day. And the amount of money moving around, we're talking trillions with a T every single day.
And this is so important to get. This market isn't just about people betting on currencies. It's literally the plumbing of the entire global economy. It's what lets a company in America pay its supplier in Germany. It helps businesses protect themselves from sudden currency swings. It's the system that connects everything.
So who's actually in this market? This chart breaks it down perfectly. And look at this. The big banks, they're running the show, handling more than half of everything. Then you've got corporations, central banks managing their reserves, and big investment funds. And see that tiny little slice down there? That's retail traders. That's us, swapping money for a vacation. It's a stark reminder that this game is dominated by huge institutions.
Okay, last big piece of the puzzle here. Not every currency plays by the same set of rules. Every country makes a really important strategic choice about how its currency is going to behave in this giant global market. We call this the exchange rate regime. You've basically got two ends of the spectrum: fixed and floating. With a fixed regime, a country pegs its currency to something else, like the US dollar. The big advantage there is stability and predictability, which is great for trade. On the other end, you have a floating regime, which is what the US has. You just let the market decide the price based on supply and demand. This gives you independence to manage your own economy. It really boils down to a classic trade-off. Do you want stability or do you want independence?
But in the real world, it's not so black and white. Most countries land somewhere in the middle. Some go all in and just adopt another country's currency, like El Salvador using the US dollar. Others, like Hong Kong, use a super strict system called a currency board. And then you have all these variations in between, like pegs that crawl or adjust slowly over time.
So at the end of the day, this choice, how you manage your currency, it's one of the biggest economic calls a country has to make. You're constantly balancing the need for a stable, trusted currency with the need to have control over your own economic destiny. And there's no single right answer for everyone.
So from the simple price of money to the giant global market that sets it, and the rules countries play by, that's the whirlwind tour of exchange rates. But the world is always changing. So you have to wonder, with digital currencies and all the shifts in global trade, what are the rules of the game going to look like tomorrow? That's the big question.